Good morning, good afternoon, and good evening, ladies and gentlemen. You are once again welcome to my channel. So, in today's video, I'm going to be sharing with you a powerful secret indicator that you can use to generate money from the forex market. And I'm going to be talking about the Bollinger indicator. So I'm going to tell you all you need to know about the Bollinger indicator and how you can use this powerful indicator to trade the forex market profitably. So what is a Bollinger band? A Bollinger band is a trading indicator developed by a technical analyst known as John Bollinger. So this indicator tells you that the market is either in the overbought or oversold condition, or the market is in a support or resistance level. So you can use this indicator along with the price action, that is the support and resistance level. So that is why you need to pay clear attention to this video. Make sure you watch this video from the beginning to the end. Don't skip any. Watch from the beginning to the end so that you understand everything that you need to know about the Bollinger Band indicator. Now, the Bollinger Band indicator has three lines. So what is the function of the Bollinger Band? The Bollinger Band is used to identify potential overbought and oversold areas in the market. It can also be used to identify the volatility of the market, that is when the market is low and when the market is high. So there are three main components that make up a Bollinger Band. We have the upper band, the lower band, and the middle band. So there are three lines that make up the Bollinger Band. The upper band has two standard deviations. The lower band also has two standard deviations, while the middle band is the 20 simple moving average. These are the three things that forms a Bollinger Band. So you have to pay clear attention on these three things because they are what forms the Bollinger Band, and that is what you should be looking at: the upper band, the lower band, and the middle band. Like I told you, the middle band is the simple moving average, while the upper band serves as the overbought or the resistance level, while the lower band serves as the support or the oversold level. So these are the things you need to understand about the Bollinger Band indicator. So right now I'm going to share with you an example of how a Bollinger Band look like so that you understand what I'm talking about. This is not going to be theoretical alone. You also see the practical and understand how it works. Now this is an example of how a Bollinger Band looks like, right? This is the upper band of a Bollinger Band. This is the lower band, and this is the middle band, right? You can see the upper band, see the line. This is the lower band, see the line, and this is the middle band. Like this upper band is a 2 standard deviation. Then this lower band is also a 2 standard deviation, and while this is 20 simple moving average SMA. So these three things are what you should be looking at, right, for you to be able to trade with this indicator. So take note of this. This is the upper band, the lower band, and the middle band. Like I said, the upper band acts as a resistance level or overbought condition. The lower band acts as a support level and oversold condition. So there are also so many things you need to understand about the Bollinger Band, right? Because it works in different market conditions. It's not the way it works in a ranging market that it works in a trending market. So there are different ways that you can trade the Bollinger Band whenever you meet different market conditions. Like I told you, the market always moves in a cycle from uptrend to downtrend, from downtrend to range. So this is how the market moves. Let me give you another example of what I'm talking about so that you understand what I'm talking about. So here is another example of how a Bollinger Band looks like, right? This is the upper band, which tells you that the price has entered into a resistance level or overbought. This is the lower band. This tells that the market has entered into a support level or oversold. And this is the middle band, or you can call it the mean, which tells you is the 20 simple moving average. So for you to make use of the Bollinger Band, you can simply go to the indicator on your trading view and plot it out, right? And then you can use the default setting of the Bollinger Band, the 2 standard deviation for the upper and the lower band, and the 20 simple moving average. That's the default setting for the Bollinger Band. So when you plot it, it looks something like this, right? Don't get confused. Before the end of this video, I'm going to show you an example on the trading view. So like I said, this is the upper band, which tells you that the price is too expensive, and this is the lower band, which tells you that the price is too cheap. So the Bollinger Band works very well in a ranging market, because when the market is in a consolidation, right, the Bollinger Band works in very well in a ranging market, especially when the market is in accumulation stage, that is, the market is consolidating. Why? Because you'll be able to identify the support and resistance level. Like if you watch clearly from here to here, you can see the market is clearly in a consolidation mood. The market is in accumulation stage, ranging. So with that, you can easily identify the support and resistance level. Like this is the resistance level and this is the support level, right? So during a ranging market, the Bollinger Band works extremely well because you can easily identify the support and resistance level. Like I told you, once the market is ranging, the upper band means that the market is in resistance level, while the lower band means that the market is in support level. So that is why I said it works extremely well during a ranging market. But during a trending market, you don't have to, right, trade it the way you trade when it is in a ranging market, because now that the market is in a range, you can simply sell at the resistance level and then buy at the support level, right? So this is the upper band of the Bollinger Band, which serve as the resistance level. So whenever price gets to this upper band and crosses it a little or touches this band, you simply sell. And when price gets to this lower band, crosses it or touches it, you buy, right? So this acts as the support and resistance level, especially during a ranging market, right? But when the market is trending, right, when the market is trending, please do not buy at the resistance when the market is trending up, and do not sell at support when the market is trending down. Like if the market is going down, you can see that the market will be in below the lower standard deviation, right? And you're not expected to sell. So what you do is that you wait for the price to come to the simple moving average before you place your sell, right? Just like if the market is in an uptrend, you don't need to sell when the market is in an uptrend. What you have to do is you have to only buy. You wait for the price to come down to the simple moving average, and then you place your buy trade. So I'm going to give you an example of what I'm talking about. You can see clearly that the market is in an uptrend, right? You can see the market is an uptrend. So you see that the market is always coming above the upper band because the market is an uptrend. You can see that the market is always coming above the upper band. So if you say you want to trade the way you trade when the market is ranging, you are going to lose a lot of money, because whenever the market crosses the upper band and you place your sell trade, the market will just drop a little and then continue up and then hit your stop loss. And whenever the market crosses again the upper band, you place a sell trade, the market will just go down a little and then continue going up, and then your stop loss will get hit. So that is why I say you don't have to trade the way you trade during a ranging market in an uptrend. You have to make use of another strategy on how to trade the uptrend. So like I said, when the market is trading up, you only look to buy, not to sell. When the market is trading up, you only look to buy, not to sell. So where do you buy? You buy at the simple moving average. So this is where you buy. You either buy here or you buy here, right? So you don't sell when the market is in an uptrend. If you watch clearly, you can see that the market is clearly in an uptrend and is respecting the 20 simple moving average. So what you do is that whenever the market comes to this 20 moving average, you place your buy trade, right? And when the market gets to the upper Bollinger band, it tends to reverse back and test the 20 moving average. So that is where you are expected to place your buy trade, right? So this is how you trade using the Bollinger band. And like I told you, if you trade the Bollinger band upper and lower during a trending market, you are going to get stop out many times. That is why I say the Bollinger band work extremely well during a ranging market, but during a trending market it doesn't work extremely well. So you need to change your strategy during a trending market. You don't use the same strategy you use during a ranging market. You don't use the same during a trending market, because like I said, during a ranging market you can simply sell at the upper band and then buy at the lower band, right? Because in a ranging market the upper band serves as the resistance level, while the lower band serves as the support level. So in a ranging market, when the price crosses the upper band of the Bollinger, it means the market has entered into an overbought condition, or the market has entered into a resistance level. So you are meant to sell. And whenever the market is trending down, you don't sell at the lower band. You only do that when the market is ranging, because whenever you place a sell trade at the upper band in an uptrend market, it tends to hit your stop loss. And whenever you place a buy trade at the lower Bollinger band in a downtrend, it tends to hit your stop loss. So you have to trade in the direction of the trend. Don't ever trade against the trend. Always trade in the direction of the trend. So this is an example of how an uptrend looks like in a Bollinger band. So once you sight this type of market, you know that you are only meant to trade in the direction of the market, which tells you the market is clearly in an uptrend. So where you place your trade is at the middle band, which is the simple moving average, right? And whenever the market comes to this simple moving average, it tends to reverse and continue heading up. So you can see clearly that whenever the market comes to the simple moving average, it continues going up. When it comes, it continues going up, comes, goes up, comes, goes up. So that is how simple the Bollinger band looks like, right? Another thing that you can use the Bollinger band for is you can use it to identify an explosive move. Like when there is an explosive move in the market, you can use the Bollinger band to know before that move takes place. And how do you know? You know that a market is about to make an explosive move when the Bollinger band starts to squeeze. For instance, the Bollinger band expands, right, which tells you the volatility of the market is high. Then suddenly the Bollinger band starts to tighten up to the extent that it begins to squeeze. The candles become very, very small. So once you notice this type of market, you see that the Bollinger band has squeezed and the candlestick becomes very small in a tight consolidation, right? In a tight consolidation, it means that the market is preparing to make a powerful breakout, either at the upper or at the lower. So whenever you see the Bollinger band squeeze and the candlestick start getting smaller in a tight consolidation, it means that a breakout, an explosive breakout is about to occur. So what do? You watch the market carefully to know the direction that the breakout is going. So if the breakout is up, then you know that you are supposed to follow the trend. And if the breakout is down, you know you are going to trade down. So this is how you trade using the Bollinger band. Let me give you an example of what I am talking about so that you understand what I mean. Now, this is what I'm talking about. This is when the Bollinger Band is in high volatility. This is the high volatility. You can see that the band expands. You can see the upper band and the lower band. You can see the space in the middle. This tells you that there is high volatility in the market. This is another high volatility in the market when the upper and the lower band expand, they widen up. It tells you that there is high volatility in the market. And what do you mean by high volatility? High volatility means when the candlestick is getting bigger or the market is trending in either up or down. It tells you that the market is in high volatility. But when the market is ranging, right, it means the market is in a low volatility. So this is what I mean by low volatility. From here to here, you can see that the market was ranging, forming smaller candles, telling you the market is in a low volatility. Then this is another example of low volatility. You can see the market are getting smaller. So this is the ranging market I'm telling you about. Whenever the price gets to the upper band, you sell. Whenever it gets to the lower band, you buy, because the market is clearly in a range. So this is what I mean by low volatility. So during a high volatility, the Bollinger Band expand. So during a low volatility, the Bollinger Band compress. It becomes tightened, right? This is what I mean by the Bollinger Band squeeze. Look carefully, you see that the candlestick are getting smaller, right? And the Bollinger Band comes together, they squeeze together. You know, before in a high volatility, the Bollinger Band expands, but now the Bollinger Band has, joined together very tight, which tells you that a powerful explosive move is about to be made. A breakout is about to be made, right? So once you notice this type of market, when you see that the Bollinger Band is now squeezing in a tight consolidation and the candlesticks are getting smaller, right, it means that a breakout is about to occur. So what you are doing, you are waiting for a breakout, because you cannot trade this particular market. Why? Because the tide is too much, right? So you can't gain anything, right? Let's just say from the upper band to the lower band, maybe just 10 or 15 pips, right? The tide is too much and the candlestick are very small, so you can't benefit anything by trading the squeeze. So what you do, you wait for breakout, right? Now you can see clearly that the volatility is very tight, squeeze from here to here. Then what happens? A breakout occur. Now once the breakout occurred, you can see the Bollinger Band start expanding. So after the tight consolidation, and the Bollinger Band squeeze for a long time, there will be an explosive breakout. Remember that the longer the tight consolidation, the longer the breakout, right? So if the tight consolidation is long, it means the breakout is going to be very deep, right? If it is an uptrend, it's going to be very high. If it's a downtrend, it's going to be very deep. So you can see that the breakout has occurred, and then this is it. The downtrend has won. So if you sight this type of market, watch for breakout, because you are going to enjoy this powerful move. So once the breakout occur, I think this is where the breakout occur, right? You can see that the candlestick is now, touching the lower band consistently. That's why I say you don't trade the way you trade during a ranging market the same with a trending market, because during a ranging market, once the candlestick comes to the lower band, you buy, right? But during a trending market, please don't buy when you see the candlestick coming to the lower band, because the market is clearly in a downtrend and the candlestick will touch the lower band so many times. So where do you place your sell trade? You wait for the candlestick to come to this simple moving average, right? This middle band. That is where you place your sell trade. So as the market is going down, when the market comes to this simple moving average, you place your sell trade. So you are only looking to sell, not to buy, because the market is clearly in a downtrend. So this is how simple you trade the Bollinger Band squeeze. Hope you're understanding what we are talking about. So this is another example of what I'm talking about. You can see before the market was in a high volatility, you can see how big the Bollinger Band is. You can see how expand it is. right? This tells you that the market is in a high volatility. You can see how big the candlesticks are. You can see how big they are. Then after that, the market now goes into a tight consolidation. So this is the beginning of a tight consolidation. So after a high volatility, the market goes into a low volatility, right? So this is the beginning of a low volatility, a tight consolidation. You can see that before the Bollinger Band expands, but then suddenly it becomes squeezed. It started compressing to become this small. So once you notice this type of market, you have to wait for a breakout, right? Just like I showed you before. So this is how you identify a breakout using the Bollinger Band. Let me give you another example of what I'm talking about. So look carefully, you see that the market is clearly in a downtrend, right? Now the market comes to this level and started to consolidate in a tight consolidation, which tells you that another breakout is about to occur, right? So you can see before the market was in a high volatility. You can see how expand the Bollinger Band is, right? You can see how expand the Bollinger Band is. Then suddenly it enters into a tight consolidation, which is from here to this place. Then what happened? It breaks below the support level and the downtrend continues again. So in this type of a market, you are only meant to sell, not to buy. Why? Because the price or the candlestick will be touching the lower Bollinger Band consistently, and if you are looking to buy in this type of market, your stop loss will get hit so many times. So in this type of market, you are only looking to sell. So like I said, you have to only trade in the direction of the main trend, because you can see clearly the market is in a downtrend. So whenever the Bollinger Band is heading down, it means the market is in a downtrend, and whenever the Bollinger Band is heading up, it means the market is in an uptrend. So you can see clearly that the Bollinger Band is heading down, telling you that the market is in a downtrend. So you only trade in the direction of the trend. And like I said before, don't ever buy during a downtrend and don't ever sell during an uptrend. So you can see that the price is always touching the lower band during a downtrend. So where are you expected to place your sell trade? Whenever the price gets to the simple moving average, you place your sell trade. Whenever the price gets to simple moving average, you place your sell trade, right? You can see that the price got to the simple moving average, right? What you do, you simply place your sell trade here and put your stop loss above this place. You can see the market went down, right? Then came up again, tested the simple moving average, went down, came again, tested the simple moving average, went down, right? Came again, tested it, went down, tested it again, went down, right? So that is why I said during a downtrend, you only look to sell. And where do you place your sell trade? At the simple moving average, which is the middle Bollinger Band. So this is how simple you trade using the Bollinger Band. That was for downtrend. So this is another example of a downtrend, right? Like I said, whenever the market is heading down, the Bollinger Band will focus down. So you can see that the Bollinger Band is focused down, telling you the market is in a downtrend. So where do you place your sell trade? You place it at this simple moving average line. You can see this arrow pointing at the simple moving average line, telling you that this is where you are expected to place your sell trade, right? Because if you decide to place a buy trade whenever price touches the lower Bollinger Band, I'll tell you your stop loss will be crying, because whenever the price touches the Bollinger Band, the lower Bollinger Band, it only head to the simple moving average and returns back, right? So you are expected to only trade in the direction of the trend. So you place your sell trade at the middle band, which is the simple moving average, the 20 simple moving average. So this is how you trade the Bollinger Band, right? Then whenever price crosses the simple moving average, it means the trend have changed direction, right? Take note of that. So you are meant to close your trade and follow the new trend. So you can see that the price got to the lower low, which is this point, and couldn't go any further low. What happened? The price breaks through the simple moving average, and then the uptrend begins, right? You can see that the price get to the lower low and couldn't go any further. What happened is it breaks above the simple moving average, comes back here to retest the simple moving average and continue heading up, which tells you that the price have changed direction, the trend have changed direction, and you are meant to close all your sell trade and then open a new buy trade because the trend have changed direction. So this is an example of an uptrend, right? This is an example of an uptrend. You can see that the price is always touching the upper Bollinger Band consistently, and if you decide to sell when the price touches the upper band of the Bollinger, then you get hurt because your stop loss will get hit so many times. So like I said, you are expected to only place your buy trade whenever the price makes a pullback at the 20 simple moving average. So you can see the price came to the 20 moving average and then continue heading up, came back again, continue heading up, came back, continue heading up. So what you do is you only watch this middle line. This is the 20 simple moving average. You watch this middle line so that whenever price comes to this simple moving average, you place your buy trade, right? And whenever the price comes again to this simple moving average, you place your buy trade. So don't ever place a sell trade whenever price touches or crosses above the Bollinger Band in an uptrend, because your stop loss will get hit so many times. So if you look at this side, you can see that the market here is clearly in a range. So this is where you can make use of the upper and the lower Bollinger Band during a ranging market. That is why whenever price gets to the upper, you place a sell trade, and when price gets to the lower, you place a buy trade, right? Because the market is clearly in a consolidation mode. The market is ranging. That is why I say the Bollinger Band work extremely well during a ranging market. That is when you use the overbought and oversold condition, which is the upper band and the lower band condition. But in a trending market, you only trade in the direction of the trend. So let me give you an example of how you can plot your Bollinger Band in a live market. Example of how you can simply plot your Bollinger Band in a live market. So here, this is a live market, right? And we're making use of the 1 hour time frame, and this is gold. So how do you plot your Bollinger Band? You simply go to the indicator. This is the indicator. You click it and you type Bollinger Band. So this is the Bollinger Band. You simply click it once, it opens. You can see this is the Bollinger Band, and the default setting, you go to the settings, you can see the upper and the lower. The upper and the lower band is blue. Then you can go to the visibility, all time frame, make sure that it's all time frame. Come back to the style. That is when you color it. Look at the blue color. Then the middle band goes with the red color, which is this. That is the middle band. Go to the input. So the middle band is the 20 simple moving average. You can see it, 20 SMA, which is this middle band, the 20 moving average, right? Then this upper band, there are the 2 standard deviation. So like I said, use the default setting of the Bollinger Band, right? So this is how a Bollinger Band looks like in a live market, right? So this is what I'm telling you about. This is clearly an uptrend, right? And you can see that the Bollinger Band is always touching the upper band, right? So where do you place your buy trade? You simply place your buy trade whenever the price makes a retracement to the simple moving average, which is the 20 simple moving average. You simply place your buy trade, right? Then this one is a ranging market, right? From here to here is a ranging market. You can see when the price gets to the upper band, it tends to come down, right? Whenever the price gets to the upper band, it tends to come down because the price is ranging. But when the price is trending, you have to trade in the direction of the trend. So this is how you trade the market using the Bollinger Band. This is how simple it is. I hope you have understand 1 or 2 about the Bollinger Band trading indicator. Please don't forget to subscribe to my channel for more educative content like this, and also don't forget to give us a thumbs up share this video on your social media handle, subscribe to this channel, and come back for more content. I remain my humble self, Austin Ikeru, and you all are welcome to my channel, Ostino FS. Thank you very much for taking out your time to watch my video from the beginning to the end, and I say may God bless you all. Enjoy the rest of your day.